Welcome to Straight Talk, the #1 YouTube channel for business owners experienced and novices alike. I'm Lou Mosca, Chief Operating Officer of American Management Services, and joining me again today is my brother, Christopher, who is the Director of Survey, actually Vice President, Director of Survey, and been doing this for, bro, between the two of us, we're pushing
years.
Almost 50 years, 45, 50 years. Who would have ever thunk it?
Mickey Mantle was right, brother.
What's that?
If I knew I was going to live this long,
I would have
taken much better care of my body.
That's for sure. That's for sure. So today, what are we going to be talking about, bro?
Well, in this episode, we're going to talk about how to increase profitability in the real world, not make-believe, not, who gives a crap, I'll just raise my prices, not, I can't raise my prices, I can't be more competitive, the market won't allow it. How to increase profitability in the real world in this economic climate, in this pandemic that we're living through. After going through the closed-loop model, I'm going to use an example of a specific industry or a company to locate opportunities for growth and profit, and to taking apart and exploring every variable expense in that business.
Okay. So, I remember I joined American Management back in '98, and one of my first clients manufactured these. You go into a grocery store like a Publix or a Wegmans or whatever they are around the country. They manufactured these deli displays, and you had all the deli meats behind them. And I remember saying to the husband and wife, I said, Kevin, so you were selling like 20 of these units a month. What do you pay for them? What does it cost you to make them? We don't know. What are we selling them for? Whatever the number was, $2,000. Okay. So we had their people in the accounting department break down the nuts and the bolts and the labor and the time and the overhead to make it. And in fact, what they were selling for $2,000 was costing them $2,100. So my job was, number one, to make them think about it. And number two was, let's figure out if we can make this better. So since I did not know how to make that thing, I got all the production people together and I said I want it to look like a Cadillac, I want it to run like a Cadillac, but I want it to cost like a Chevy. Okay? And they actually took the whole thing apart and were able to now rebuild it for $1,500. All right? So to me, true profit opportunities are not like saying, let's raise prices 1% or let's see if we can cut overhead 1%. It's really taking what you're doing, understanding your true costs, and then figuring from there what do you want your margin to be, and if you can lower the bridge, your true costs, and raise the water. All right, did I say that wrong? I said that wrong. If you can lower the water, bring your true costs down, and raise the bridge, bring your pricing and your margin up, you'll always find ways to improve profitability for your clients.
So, for somebody, again, who's been an operational person his whole life, I've told this story so many times that the analysts that work with me laugh, but, Lou, we grew up in a family of stonemasons and plumbers. We had the best family in the world without a lot of education, and we were taught to work hard and be honorable. But I never wanted to be the guy who put the green visor on and was the accountant, right? Thank God you did. So to me, all this lowering and raising and overhead and stuff, it gets a little blurry. So it's as simple as this in my mind. Ready? There's 100 cents in a dollar. Even a clown like me can add to 100. So if my expense dollar is 100 cents, I got to make sure that everything I make, sell, process, produce, whatever, costs me less than 100 cents so I can be profitable. And when you talked about they didn't know what it cost them to make that storage unit, that canister for the display, they didn't know that it was costing them 105 cents to sell something for 100 cents. So during the analytical process of a business survey, we figure that out with people. We figure out what it costs to generate $1 in revenue so that we can control the variable expenses. That's what we're trying to do.
Makes perfect sense, and it's very discouraging that a lot of owners don't know their true costs. Very discouraging.
In this episode, we're going to talk about the difference between hoping to make money and planning how to manage profit as an absolute in any economic climate. Interesting words, but it's pretty critical today in this economic climate where most of our clients have seen their revenue drop from 30 to ungodly percentages to 70% in revenue. So this model here shows how most folks run their business today with a basic one-tier profit plan. If you're my age, or give or take, you were taught this as break-even analysis. If you're a younger fellow or lady who's gone through business school, you've probably never heard that term, but it's called residual analysis. And it basically goes like this. Every business has a timeline to generate revenue. The IRS has no sense of humor about a 13-month year. Ask the guys at Enron that all went to jail, okay? So this example shows a calendar year. Some people use a fiscal year. This example shows a calendar year, ties into the module we did before in profit opportunities. This example shows a 12-month window from January to December where the business generated $5 million in sales. So from the first day of January at 0, this company worked really hard to get to $5 million in sales. To generate that revenue, they had to pay their bills or their expenses, right? So we broke the expenses down to $1 in revenue and $1 in expenses. In this example, the first line item of expense is the fixed expenses, the things that have to be paid whether we make money or not. All right? And from American Management's perspective, and as a consulting company, we look at fixed expenses different than your CPA would. Fixed expenses to us are plain and simply this, the things that only you can pay. Okay, and only you determine how they get paid. So owner's compensation is a fixed expense. You decide what you pay yourself. Your facility costs, you decide whether you want to own or rent. The taxes associated with that facility. If you own, you have to pay the real estate taxes. So this isn't sales taxes, things like that. It's real estate tax. Key man insurance, if you have a partner and you don't want your partner's spouse to become your partner if something happened to him. Interest expense. Our healthy clients loan their companies money every day and take 8 or 10% interest. That's an owner's discretion to pay himself income that way. Other companies, not so healthy, have to borrow money. An owner has to go to a bank, get a line of credit. Worse than that, go to a factor. God forbid, worse than that, go to a guy in a bar. All right, but interest expense is something the owner decides I'm willing to take on this risk. And then how you fund depreciation at year end. Have a healthy year, don't want to pay a ton of taxes, you accelerate depreciation talking to your CPA. Don't have a healthy year, the bank's crawling up your backside. You might not fund depreciation to show a paper profit to keep the bank off your back. Unfortunately, you might pay taxes on money you didn't make. But once again, 6 fixed expenses. In this example, the 100 cents of this company's expense dollar, 10 cents were fixed expenses. If these are fixed, these other two then become variable expenses. The next is the cost of goods sold, the direct cost of moving this business, labor, materials, equipment, inventory, things like that. And then the next variable expense is the indirect costs like selling and general administrative expenses. So in this example, this company started the first day of the year, busted their backsides to get to $5 million, and to do that, they spent 98 cents of their expense dollar. And this is how the expenses broke out. So they hit their break-even point, right, where revenue and expenses merged. They hit their break-even point in the second week of December, and they made a 2-cent profit. So plain and simply put, this is a one-tier profit plan, or old guy like me, break-even analysis. Younger folks would call it residual. You keep the leftover. The work that we did in the prior module that showed profit improvements of $400,000 on this company showed where the errors or the mismanagement was taking place. So what is happening, this is what should have been happening in that company. And instead of hoping to make money by hitting this break-even point and keeping the leftover, we believe in a 2-tier profit plan. And the 2-tier profit plan is predetermined profit and penetrated profit. But the key to this is it means from the first day of the year, we're going to manage profit as an absolute. We're not going to hope to make money at the end of the year. So if we were to take what is happening in the company, the cost of goods sold was 70 cents, the direct costs. The work that we showed that it should have been 64 cents. The administrative expenses, the selling and G&A expenses were 18 cents. It should have been 16 cents. So what changed here is instead of hoping to make money, we can now predetermine our profit by controlling our expenses. So by mitigating those errors and putting the systems and the controls in place that we talked about in our closed loop model so that we could manage and hold people accountable, we can now spend 90 cents to generate $1. So from the first day of the year, we can manage profit as an absolute. We can still hit this point where here it was break even. Here it's now a second tier. First tier, predetermined profit. Second tier, penetrated profit. Plain and simply put, we beat our plan. So that means that we now have a second tier profit that we think should be used to fund owners' wealth. You take the risks, you should get paid. drive the business forward. There's always capital expenditure, whether it's equipment, maintenance on your facility, marketing expenses, or plain and simply put, you want a discount without eroding your margins, okay? And an incentive-based pay plan. Make people dance for their dollar. Make your staff feel like they have ownership, but that they earned it. Instead of cost-of-living pay raises that do nothing, a pay-for-performance plan that makes people excited and happy to work for you. And we think that should come out of second-tier profit. So made 2 cents. Should be in a 2-tier profit plan, manage profit as an absolute from the first day of the year and turn the 2-cent profit company into a 10-cent profit company. If you're doing something like this in your company, you're an exception, keep doing it. If you like the idea and this helps you, please implement it. If you like the idea and you don't have any clue how to do this because no one's ever given you the tools and the training, call the 800 number. So in this example, we used a company that broke their backsides, generated $5 million, and had a modest profit of 2 cents, all right, 2%. Just so you understand, this 2-tier predetermined and penetrated profit plan can work with companies that aren't making money, all right? And here's an example of the exact same company where their fixed cost was still 10 cents, but their direct cost was 72 cents, and their SG&A was 20 cents. So simple math said they're spending 102 cents to generate $1 in revenue. That makes them the federal government. Okay, we're just going to keep spending and hope we make money. So where they would have hit their break-even point here and kept that, their break-even point here and kept that 2 cents, in this model, we're showing a company that the owners worked just as hard to get to 5 million, but that point happened outside that 12-month window. And since the IRS has no sense of humor for 13-month years, this company had a 2-cent loss. So that same model can work. The difference is if we mitigated these errors with the corrections we did in the profit opportunity page, instead of making 10 cents as profit, we would be making 8 cents because we'd have to mitigate the loss. Short version, you could be making money and implement a 2-tier profit plan to do better. You can be losing money and implement a 2-tier predetermined and penetrated profit plan to save your bacon and build equity and wealth. If it makes sense, please implement it. If you understand, please use the tools. If you don't, again, call us and we'll help you.
As always, this closed loop management system is extraordinarily effective, whether it is on looking at your costing, looking on your pricing, looking at how you control your labor or your people. And if you have any questions, please feel free to comment below or give us a call anytime at 800-743-0410. Speak to any one of us anytime. All you got to do is ask. If you call here and you say, I'd like to speak to Chris Mosca, we'll get you to speak to Chris Mosca. If you call here and you say, I want to talk to Michael Lockey, that's who we'll get you, okay? No baloney. We're here to try to help you out. Remember, click subscribe and ring the bell to get notified when we release the next video in this series.